Commercial real estate is not collapsing in panic. It is failing in place. Office buildings are not being sold. Loans are not being repaid. Values are not being discovered. They are being avoided. Unlike banks or funds, commercial real estate cannot move quickly. Assets are illiquid. Prices are slow. Losses remain unrealized as long as no one is forced to sell. This has created a different kind of crisis. Not a run, but a freeze. Not a shock, but a stalemate. As interest rates rise and refinancing deadlines approach, a system built on cheap money and constant rollover is quietly running out of time. This is the story of a market where everyone sees the problem, but no one can exit without triggering it. Commercial real estate has long been treated as a stable pillar of the financial system. Office buildings, retail centers, and multifamily housing generated predictable cash flows and were commonly financed with long-term debt. Pension funds, insurance companies, and banks relied on these assets for steady returns. The model depended on three assumptions: stable occupancy, gradual price appreciation, and continuous access to refinancing. As long as rents were collected and loans could be rolled over, valuations held. After the global financial crisis, low interest rates reinforced this structure. Capital flowed into real estate as investors searched for yield. Prices rose, leverage increased. Office space, in particular, expanded in anticipation of permanent demand. By the late 2000s, commercial real estate was deeply intertwined with regional banks and institutional investors. Its scale was not explosive, but embedded. That embeddedness would later become a constraint. Commercial real estate sold predictability. Long leases, tangible assets, and stable tenants were framed as protection against volatility. Unlike equities or startups, buildings appeared solid. Value was assumed to persist through cycles. To lenders, the promise was collateral. Loans were secured by physical property, appraised regularly, and supported by rental income. Even if markets shifted, time was believed to be on their side. Investors were told that risk was low and duration was long. Real estate was positioned as an anchor asset, suitable for conservative portfolios. Refinancing was treated as routine, not conditional. This promise rested on continuity. Interest rates were expected to remain manageable. Occupancy was assumed to recover after disruptions. Work patterns were believed to normalize. What was underestimated was structural change. When assumptions break slowly, they are not rejected. They are deferred. The rise of commercial real estate accelerated after 2009. Cheap capital and accommodative policy made leverage attractive. Developers expanded. Investors acquired assets at rising valuations. Regional banks increased exposure, using real estate lending as a core profit engine. Office buildings became financial products as much as workplaces. Value was driven by financing conditions as much as usage. As long as debt could be rolled over, cash flow mattered less than access to capital. This structure created scale without liquidity. Assets grew in value on paper, but transactions slowed. The system worked because refinancing was always available. When interest rates rose sharply and remote work reduced office demand, the foundation shifted. Loan maturities approached with no clear exit. Selling would lock in losses. Refinancing required higher equity and lower valuations. Commercial real estate did not lose relevance overnight. It lost flexibility. The rise produced assets that could not easily adapt when conditions changed. The system failed through immobility. As interest rates rose, commercial real estate loans approached maturity with financing terms that no longer existed. Properties purchased under assumptions of low rates and stable occupancy faced refinancing at higher costs and lower valuations. The gap could not be closed without accepting losses. Banks and investors responded by delaying recognition. Loans were extended. Appraisals were adjusted slowly. Losses remained unrealized as long as transactions did not occur. This created the appearance of stability, while risk accumulated beneath the surface. Occupancy declines, particularly in office buildings, reduced cash flows. Remote work changed demand structurally, not temporarily. Yet pricing did not adjust proportionally because selling would force valuation resets across portfolios. The system preferred stagnation to clarity. Regional banks were especially exposed. Commercial real estate loans represented a significant share of their balance sheets. Writing down assets would weaken capital ratios and restrict lending. Avoidance became rational behavior. The failure was not a collapse in prices, but a collapse in liquidity. Markets require transactions to function. In commercial real estate, transactions slowed to a standstill. Without price discovery, risk could not be redistributed. What broke was the refinancing loop. A system built on rollover encountered a world where rollover was conditional. Time, once a buffer, became the constraint. The longer resolution was delayed, the fewer options remained. There was no single moment of collapse. Instead, pressure accumulated unevenly. Some properties defaulted quietly. Others were restructured. Banks reduced exposure selectively. Losses appeared gradually, dispersed across institutions and regions. This fragmentation limited immediate contagion, but extended uncertainty. Investors could not assess scale because outcomes varied. Markets remained functional, but hesitant. Capital retreated. The absence of a dramatic failure masked the seriousness of the problem. Unlike a bank run, there was no visible trigger. The system did not freeze overnight. It slowed, absorbed, and deferred. Commercial real estate entered a prolonged adjustment phase, not a crisis of panic, but of persistence. The collapse, if it arrives, will not be sudden. It will be recognized only after options are exhausted. The aftermath is ongoing. Banks are reassessing exposure. Investors are demanding higher returns. Developers face constrained financing. Cities confront declining tax bases and underutilized infrastructure. The system has not failed outright, but it has not healed. The reliance on delay has preserved order at the cost of dynamism. Real estate remains, but flexibility has diminished. Commercial real estate illustrates how systems can survive by avoiding resolution. The cost is not collapse, but stagnation. Commercial real estate shows how crises can exist without visibility. When assets cannot move, risk cannot move either. Systems built on refinancing require trust and continuity. When continuity breaks slowly, denial replaces response. This is not a story about excess or deception. It is about rigidity. Markets adapt through movement. When movement stops, adjustment becomes painful and prolonged. The danger is not sudden failure, but being trapped between values that no longer reflect reality and structures that cannot adapt. Commercial real estate is not collapsing. It is waiting.